Hi everyone, welcome to Askbizsquare episode 8, and today I'm going to share with you what is TDSR, and let's get into it now. TDSR basically is the limit that the amount you can spend on your monthly debt servicing up to 60% of your gross income. It's being introduced to ensure that borrowers are aware and are able to afford the loan. At the same time, it's being created to manage the property market in Singapore. And ultimately, we are here to standardize the different credit assessment from different banks in Singapore as well. So how does TDSR affect your loan? So TDSR actually set a restriction over the total debt that you are able to get. It comprises of your total home loan, personal loan, educational loan, and all different type of loan into your total debt. And if it actually falls within 60%, you basically pass. If it's not, then you basically exceeded and you fail. So how is TDSR being calculated? It's being calculated by taking the borrower's monthly total debt obligation divided by the borrower's monthly income times 100%. And with this, you are able to get the TDSR. I'm going to show you guys two examples. One example will be the guy with fixed income and the other guy with variable income. So for example, Eric, who has a fixed income, earns an income of $10,000 a month with a debt obligation of $4,500. TDSR calculation is using monthly debt obligation divided by gross monthly income. With that, 4.5k divided by 10k equals to 45%. So his TDSR threshold is 45%. Okay, so if you take 6,000 minus 4.5k, it means that 1,500 will be the maximum repayment he can afford to pay each month for his house loan. So if Eric requires more loan, he will definitely need to repay his outstanding debt. Next, we have Jess, who is a freelance piano teacher who makes $10,000 a month. As a freelancer, you are considered making variable income, and variable income is subjected to a 30% haircut. So her accessible income will be $10,000 times 70%, which is $7,000. And with a debt obligation of 4.5k, her TDSR calculation would be 4.5 divided by 7,000, which is 64.28%. With what I said just now, 60% mark is the mark where you pass your TDSR. So with this, she has failed her TDSR. If she requires a loan to finance her property, she will definitely need to pay off her outstanding debts. So how do you calculate TDSR as a joint applicant? So for example, we have Daniel here with a fixed income of $3,000 a month and Daniel's wife with a fixed income of $5,000 a month. Daniel has a debt obligation of $1,000 and his wife $2,000. So the TDSR calculation, you actually plus both obligations together and you plus both income together. With this, you have $3,000 over $8,000 and you get 38%, which is past a TDSR. As such, how much extra loan you are able to get, which is 1,008 extra loan. So from this, you can actually see that you can buy a house at a monthly installment of 1,008. I hope all of you actually learned something today about TDSR. So next time when you are applying for your housing loan, do take note of your TDSR and your debt that you actually have. And I hope all of you actually benefit from this episode of Askbizsquare. And do stay tuned for our next episode of Askbizsquare. Remember to subscribe and like our video. So see you, bye!